Ever wondered what terms like ATM, OTM, ITM in options trading mean? Well, you're not alone. The world of options trading has its own unique language, and understanding this language is key to making informed trading decisions. Options trading is a type of derivative trading that allows investors to buy or sell an asset at a predetermined price within a specific time period. In the realm of options, terms like at the money, out of the money, and in the money, along with intrinsic value, time value, and option Greeks play a pivotal role. These terms may sound complex, but don't worry, we're going to break them down one by one, making them easy to understand. By the end of this video, these terms will be as familiar to you as your morning cup of coffee. So gear up as we're about to embark on an enlightening journey into the world of options trading. Get ready to dive deep into the world of options trading. Let's start with ATM, or at the money. Now, an option is considered at the money when the current market price of the underlying asset matches the strike price of the option. In simpler terms, it's like hitting a bullseye in darts, where the dart is the market price and the bullseye is the strike price. For a call option, this means the stock price is right on target, at or near the strike price. Imagine you bought a call option with a strike price of $50, and voila, the market price of the stock is also $50. Your call option is now at the money. On the flip side, for a put option, the stock price also needs to be at or near the strike price. So, if you had bought a put option with a strike price of $100, and the stock price drops to that exact figure, your put option would be at the money. To put it briefly, at the money is the Goldilocks zone in options trading, where the market price is not too high or too low, but just right, matching the strike price. It's a delicate balance, and the market price doesn't always hit the bullseye. But when it does, your option is at the money. That's ATM for you. Moving on to the next term. Next up, we have OTM, or out of the money. This is a term you'll often hear in the world of options trading. When we say an option is out of the money, it means the current market price of the underlying asset is less favorable compared to the strike price. Let's break it down. If we're looking at a call option, an OTM scenario means the stock price is below the strike price. So, if you have a call option for a company's stock with a strike price of $100 and the current market price of the stock is $90, your call option is out of the money. Simply put, it's not profitable to exercise this option at the moment. Now, if we flip the script and talk about put options, an out-of-the-money situation is when the stock price is above the strike price. For instance, if you hold a put option with a strike price of $100, but the stock is currently trading at $110, your put option is out of the money. In this case, it doesn't make sense to sell the stock at the lower strike price when you could sell it at the higher market price. Remember, an out-of-the-money option isn't necessarily a lost cause. Depending on market movements, it could move in the money before expiration. Now that we've covered OTM, let's move on to the next term. Up next, let's discuss ITM, or in the money. This is a term that you'll hear quite often in the world of options trading. So what does it mean when an option is in the money? An option is considered ITM when the underlying asset's current market price is more favorable compared to the strike price. Let's break this down a bit further. For a call option, this means that the stock price is above the strike price. So, if you have a call option with a strike price of $50 and the stock price soars to $60, congratulations, you're in the money. On the flip side, for a put option, the stock price needs to be below the strike price to be considered in the money. So, if you've got a put option with a strike price of $100 and the stock price drops to $90, you're in the money. The joy of being in the money is that the option holder can exercise the option at a profit. But remember, just because an option is in the money doesn't mean the option holder will always choose to exercise it. There can be other factors at play, such as transaction costs and taxes, which could influence this decision. With ITM under our belt, let's delve into some more complex terms. Now, let's discuss two fundamental concepts in options trading: intrinsic value and time value. First up, intrinsic value. It's the part of an option's value that comes from the difference between the option's strike price and the current market price of the underlying asset. Think of it as the built-in worth of an option if it were exercised right now. For a call option, intrinsic value is the greater of zero, or the stock price minus the strike price. Conversely, for a put option, intrinsic value is the greater of zero, or the strike price minus the stock price. So, if we have a call option with a strike price of $50 and the stock is currently trading at $60, the intrinsic value is $10. Now, on to time value. This is the part of an option's premium that isn't intrinsic value. Essentially, it's the extra money you're willing to pay for the potential that the option could gain intrinsic value before expiration. Time value is influenced by factors such as the time remaining until expiration, the volatility of the underlying asset, and interest rates. The closer an option gets to its expiration date, the less time value it holds, and the more its worth depends on intrinsic value. Let's say we have an option that costs $5 and its intrinsic value is $3. That leaves a time value of $2. But as we near expiration, if the stock price remains static, that time value will shrink, reducing the overall option value unless the intrinsic value increases. In essence, intrinsic value is the immediate worth of an option, and time value is the potential for future worth. Both these values play a significant role in an option's premium, and understanding them is quite like having a secret key to unlock the mysteries of options trading. Understanding these values is crucial to successful options trading. Now let's move on to our final topic. Finally, let's discuss something called option Greeks. These are vital tools that show how different factors impact the price of options. First up, we have delta, represented by the Greek letter delta. This measures the sensitivity of an option's price to changes in the price of the underlying asset. Think of it as the speed of your car. If you're driving at 50 miles per hour, a small change in speed will have a noticeable effect. Similarly, if the underlying asset's price changes, delta shows how much the option's price will change. Next, we have gamma, denoted by the Greek letter gamma. Gamma measures the rate of change of an option's delta in response to changes in the price of the underlying asset. So, if delta is the speed of your car, then gamma is the acceleration. It tells you how quickly the delta is changing as the underlying asset's price changes. Let's talk about theta, represented by the Greek letter theta. Theta measures the sensitivity of an option's price to the passage of time. As we know, time is a crucial factor in options trading. As options get closer to their expiration date, their time value decreases. Theta helps traders understand how much an option's price will decrease as time passes. Next on our list is Vega, represented by the Greek letter nu. Vega measures the sensitivity of an option's price to changes in volatility. In the world of trading, volatility refers to the degree of variation in the price of a financial instrument over time. Higher volatility means the price of an asset can change dramatically in a short time, making it possible for traders to experience significant gains or losses. Vega helps traders gauge how much an option's price will change with a change in volatility. Lastly, we have Rho, denoted by the Greek letter Rho. Rho measures the sensitivity of an option's price to changes in interest rates. While interest rates don't often change dramatically in the short term, they can have a significant effect on the price of options over the long term. To give you a brief example, let's say we have a call option with a delta of 0.5, gamma of 0.1, theta of -0.01, vega of 0.2, and rho of 0.05. If the price of the underlying asset increases by 1 unit, the option's price will increase by 0.5 units, delta. If the asset's price increases again, the delta will increase by 0.1, gamma. Every day that passes, the option's price will decrease by 0.01 units, theta. And if the volatility increases by 1%, the options price will increase by 0.2 units, Vega. If the interest rates increase by 1%, the options price will increase by 0.05 units, Rho. And that wraps up our discussion on option Greeks and options trading terminology. Let's quickly recap what we've learned today. We dove into the world of options trading, exploring terms that help us navigate this intricate landscape. We talked about at-the-money or ATM options, where the market price equals the strike price. Then we moved to out-of-the-money or OTM options, where the market price is less favorable compared to the strike price. In contrast, we discussed in-the-money or ITM options, where the market price is more favorable than the strike price. We also explored intrinsic value, the difference between the option's strike price and the current market price of the underlying asset. Time value, the portion of an option's premium not related to intrinsic value, was also covered. Lastly, we delved into option Greeks, the measures of how various factors impact the price of options. Remember, understanding these terms and concepts is key to successful options trading. Thank you for watching.